Hey guys, welcome back to the channel. Today I wanted to go over the sort of changing market dynamics that are happening recently, and what it means, going forward from even a long-term perspective. So I wanted to go over 4 different things that could possibly be changing, the assumptions that we've made in the past that might not hold true, and then I'm going to go over four lessons that I've learned that I think will still remain true. When I first started investing, I worked for an investment consulting firm, and they were very traditional. They believed in diversification, in sort of like benchmarking against other peers in their cohorts, and there were sort of like a very long-term perspective on sort of like modern portfolio theory. But I think in the past few years, we've seen some changes to the markets um, as different asset classes have become more correlated with one another, and as like retail investors have become a bigger part of the conversation, and as ETFs have become sort of like a huge part of that. So I wanted to just like talk through what sort of like lessons we've had in the past that might sort of start to shift, and what things we can still sort of rely on. And so, like, to get started, let's go over the first one. So that's that stocks will always go up over the long term. And on the whole, I think that's what everything's built on. That equities are going to continue to go up. But I think we're like understanding now that there can be these big pullbacks. I mean, obviously we've seen recessions in the past. I think that there's so much potential for disruption now that like being able to understand where those gains are going to happen is very important. We've seen that like the Mag 7 has driven so much of the S&P 500 growth, that we have to sort of start to think strategically about what equities are going to go up, because simply betting on the market as a whole might not necessarily pay off. So first off, this assumption that stocks will always go up is, probably still going to hold true, but it's a little shakier than we've assumed in the past. There's a lot of valuation risk. There's a lot of concentration risk now. I think everyone is pretty aware that like these giant tech stocks have taken up so much of these index funds, that it's just like they keep buying into the same stocks over and over again. And so that changes the dynamic of the stock market, right? So you have tons of people buying into these passive ETFs, especially buying into S&P 500 ETFs. And so what happens is it just sort of like keeps this feedback loop of retail investors buy into these funds. The funds have to then purchase these big giant stocks because they like are weighted so heavily inside these. So it just keeps pumping up the valuations on these stocks, even though it's not like based on any like fundamentals metrics. It's just based on cash flows coming in and having to purchase them. So again, this just means that if that ever stops happening, you could see a pullback. It might just mean that like the market is moving up isn't driven really by any sort of valuation metrics. Okay, so the second bet. So over the last like probably 15 years, U.S. stocks have been outperforming international stocks, and over a longer period of time, diversification is shown to really help. But I think that there's been so much money being poured into the U.S. market, and there's been this dominance of sort of U.S. stocks that might sort of start to shift, because again, we're seeing, like as I've mentioned, this like massive inflow of money into the S&P 500. It might be bolstering that those U.S. stocks just from capital inflows, and so like we might really need to see, or not start to have to think again about really investing in international equities. Again, it's kind of like not seen as like super like sexy or attractive, but once the U.S. market pulls back, then it'll be seen as a smart move. Because yes, in emerging markets equities and international developed equities haven't quite kept pace with the U.S. markets, but again, that could shift as capital starts to sort of flow in a different direction. Okay, so the next one I'm going to talk about is diversification, which, I still believe in diversification, but the merits of diversification have sort of like begun to diminish because of how correlated all assets have become. So, like previously people would basically like allocate some portion to bonds and some portion to stocks because they were seen as sort of like good hedges against each other. So when one went up, the other wouldn't go, would either like not go up by as much, or would, if something went down, then it wouldn't go down by as much. But now it's sort of like we're seeing more correlation between the bond markets and the equity markets, and we're seeing a lot more correlation among equities. So it's really hard to find diversification that's actual diversification, especially when there's a lot of volatility in the market, because you're looking for protection, especially on the downside, and that's kind of what's important to your portfolio. It really just like helps stabilize your portfolio during those sort of pullbacks. So another thing to consider is like, where can we find diversity in our portfolio that actually has lower correlation? So we'll have to be more more diligent about selecting assets that actually provide diversification benefits. So the next one up is kind of like not really relevant to most investors because it's inaccessible to sort of an everyday retail investor. But basically that private equity and alternatives are sort of a good investment. So that's going to be kind of debunked. I think we saw like Yale is liquidating a lot of its private equity portfolio. And so traditionally you would expect private equity to way outperform the public markets, but recently we've seen that the way that money has sort of flowed into those funds has sort of like diluted sort of the performance of them. And you always were giving up liquidity in those private equity markets for higher returns, but I think we've seen also that just like the market for IPOs and acquisitions has really softened. So it's becoming harder and harder to find exits for those private companies. And so, and probably better, for the average retail investor that, we couldn't ever get into those funds. And even for like people who could get into those funds, they have to get into the highest quality funds to be able to make it worthwhile. But private markets probably won't maybe do as well as they have in the past. Okay, so those are some considerations just, about like what's sort of changing in the market. So what can we still rely on? And from like a really high level view, I think what we can always rely on is sort of like our own psychology. So we have to make sure that we're not behaving emotionally. So first up, I think what will still remain true is that this old adage of time in the market beats timing the market. And so you're better off just getting into the market as early as possible and then trying to time any dips. Because it's shown that if you miss any of those really high up days, which could come after really low swings, that you really miss out on most of your returns. So the goal should always be to invest as often as you can, as early as you can. I think that defining that as a good investing behavior will help increase your returns over time. See, again, it has nothing to do with like what stocks you select. It's really just about getting in early and continuing to invest. So again, it's about discipline. Secondly, I think like, and this is always sort of like just a tried and true method, is just like keep your costs low. Passive index funds are great because they're so low cost. It's really hard for active managers to outperform the market. So you're better off just like saving the money because it's going to compound over time, right? Even if you're spending just like 10 basis points on a fund, like that's going to compound every year over time. Like we know how important compounding is. So that also works on the fees that you're paying, right? So making that back in fees is just free money. And you're going to have a drag on your portfolio if you're paying excessive fees. So like look for sort of the funds that are the cheapest in, that provide basically the same investment. And then be wary of paying 1% to a financial advisor. I mean, they do bring value in the sense of like allowing you to ask them questions and help, just manage the portfolio if you really just like don't want to look at it at all. But realize that like that 1% drag is pretty great. It's not a small amount of money to spend every year, and that's going to drag on your portfolio every single year, because like investing is about compounding over the long run. The next thing I'll talk about is like, it's just generally speaking, your behavior, setting your targets, so setting your asset allocation targets, sticking to them, staying disciplined, not becoming emotional. That's always going to be beneficial to your portfolio outside of like trying to forecast like what's going to happen with the markets. Honestly, I don't really care whether people invest in individual stocks or if they invest in ETFs, broad market ETFs, even if they invest in active managers. My main thing is just start investing. Like, just put money in and don't take it out. So you'll just have to do that, right? You can't start like pulling triggers. Like, you can't like take money out when you get scared or because you just like decided you don't want to invest anymore, because that's what's going to eat away at your returns. You're going to have a tendency to get scared and then sell when it's low. And that's the worst thing you could do. So just like dollar cost average in, be disciplined, stick to your targets, rebalance, just, set your strategy and then stick to it. Don't get emotional and change because, you've decided you don't want to invest anymore. And lastly, you can still buy assets that are, fair valuations. I think making sure assets that like pay you in dividends or in some sort of yield is always good, because in uncertain environments, at least you have cash flowing through, and that will provide you liquidity. It'll provide you the opportunity to purchase new assets. It gives you consistency. And so that is over time useful as it allows you to make tactical moves, and it just provides you some assurance that there are future payments happening. So, obviously like investing is changing. I think the markets are changing. Consolidation of wealth and concentration of sort of assets within a lot of these funds, in the top stocks is changing how investing is working. But investing as a whole isn't like collapsing or anything. I wouldn't say like the rules are broken or are thrown out the window. They're just evolving. So if you can sort of adapt and just like stay disciplined, I think that's like the most important thing to do. I would just say like stay the course, rely on your sort of like major tenets of investing early, investing often, sticking to your target weights, and then rebalancing to those weights. If you do that and you keep costs low, you really are going to continue to grow your portfolio, and it will set you up for success in the future.